Get my dollar trade playbook to learn how to position, profit, and protect during a dollar devaluation. Scan this QR code or click on the link in the description. Hey, greetings and welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht. You can't see it, but I actually stretch my arm like this, Hans. Our options mentor, and he and I come together on these Wednesdays and basically talk the macro event risk. Then we dig into kind of sector rotation, at least that's my focus. And then we get into stocks. We also answer questions, look at option education, option tactics. You're welcome to ask us anything. We got lots on the agenda this week. Oh my God, jam-packed. It's not just economic data. We've got GDP out of the way, non-farm payrolls on Friday, which could be a little interesting the next few months. And I've got a reason for saying that. But for right now, we have FOMC out of the way, and as expected, no rate cut. In fact, Powell really pushed back. So he's not going to be anyone's plaything, but definitely we had two dissenters, which were expected, Waller and Bowman. Waller was out actually at a Bloomberg interview not too long ago talking about how the job market is showing some early signs of cracks. You don't want to be on thin ice when it starts to crack. I think that was code and cover for be careful on a non-farm payroll print, because if we do have no reason for rate cuts, but for right now, if the employment situation starts to change, then the chance for Powell's resignation will become louder, and Waller may very well put himself in path for Fed chair next year. So in the meantime, we are getting through a wonderful bit of macro commentary that I'll give on this Powell presser in a minute, but I had luckily or good just warned yesterday in clients in a big post that said, literally, do not wait to hedge. And underneath the surface, I had 5, not 1, not 2, not 3, not 4, but 5 indicators of mine that were showing weakness. So obviously we had done nothing wrong. It was 6,400 pushing. But underneath the surface is what I look for in net selling and currency volatility, which can seep into equity volatility. Same thing with treasuries. Anyway, long story short, I had 5 very, very good reasons why I was strong in my wording. Do not wait to hedge. Anyway, and we had a nice little dump after Powell spoke. Now, we also have Microsoft earnings out, and they are hot fire flames right now. Everyone is like, wow, look at that. They were important for lots of reasons. And I know, Hans, you've got a position, I think, in Meta, but Microsoft for me was a much bigger important tell on the sentiment of the AI ecosystem. If it had failed in any way, shape, or form, and we'll have to see what the reaction is, that's more important. We were going to have a much bigger softness in the FANG 7 and the NASDAQ, because they really are just unparalleled as it relates to their moat and their strength of late. So doesn't mean they can't come to some profit taking, and that's exactly what we're likely to see after this big beat. But talk to us a little bit, since you are looking at Meta in particular and Microsoft as a tell, and what do you look at the market now that Powell has spoken and the market has pulled back?
Well, I mean, to your point, I think these big caps are just too big. I mentioned maybe a couple of weeks ago, we saw this. People had looked at these leaders over the decades, and a certain amount of change. In the moment, you feel like, oh, this huge company is never going anywhere. But things do change a little bit over time. And we've had the least change over the last 10 to 15 years in terms of the big cap, the leaders, and of course, they're all technology. And there's almost no way to compete. I know that I always say, look, moats can become puddles pretty quickly, but it's really hard to compete. It's like trying to start an oil field in your backyard and competing with the Saudis. It's just not possible. They have all the data. They have all the eyeballs. They have the ecosystems. To your point, Microsoft, the reason they do well, I keep talking about how they have this ecosystem. So AI, to me, in the end, one's going to be better than the other and maybe a little bit worse. Right now, Gemini is great. Now they're talking down GPT. And so there's sort of opinions depending on your use case as well. Some are better than others.
You're going in and out, Hans.
Is that a little bit better?
Much better. Hallelujah.
Okay.
Yes.
I think the AI is going to be a bit almost commoditized over time, but really the benefit is going to be, well, how does somebody use this? Are they going to take AI and go, okay, well, here's something like Altman yesterday said, okay, here's a new education initiative. So this is how we're going to approach, we're not going to need universities. My kid's not going to university, he said. He probably won't have to. So it's how we're going to use this AI. And a company like Microsoft and Google, I have to say, already has this ecosystem. So they're sort of in the right place at the right time in a sense, because they have the value-driven part of their business that that benefits from the AI as opposed to OpenAI. I mean, it's amazing, but it's cheap. They're spending tons of money till the cows come home. Like, where's the money going to be made? Well, they're going to have to figure out how to turn that into money at some point. Well, Microsoft's already doing it. Meta's already doing it. People are, or these big companies, and that just doesn't change. Look at the data that Google has. I mean, these companies just aren't really going anywhere. Even if Google loses their search, they've got an incredible sort of ecosystem and all that, and all these other things like YouTube and all those superpowers. So there's really no changing. I don't see how the big companies, okay, maybe somebody in China comes up with a better GPU. Big deal. I don't care. Like 20 years of using CUDA for NVIDIA, nobody's going to really flinch too much about that because, as I said, I don't think one's going to be a whole lot better than the other. I could be wrong. I'm not a big data guy like Jeffrey Hinton, but so it's kind of interesting that you're talking about. I've been sort of starting to get out of some positions, some long calls.
Before you go that real quick, before into your position, let me just comment on that. I actually am extremely focused on China's AI tech dominance over the US. So I know it's dismissed locally. However, there are now analysts in the US going, wait a minute, Huawei is doing amazing work. And maybe individually they don't have the products, but you put it all together and it's stronger than NVIDIA. So there is absolutely a hubris, I think, for sure, that US is going to maintain its AI tech dominance, its tech dominance in general. Now, remember, here, sure, Europe, maybe, but in China, it could turn very, very sharply, especially if the US continues to ratchet up this trade war banter, which is China, if you continue to get oil from Russia, we're going to slap you with a 100% tariff. Come on. China's going to continue to get oil cheaply from Russia and Iran. They're going to continue to try to settle trade in gold outside of the dollar, and there's nothing Trump is going to be able to do about it. And more importantly, their chip ecosystem as it relates to ability to fabricate and deploy is much farther along. And the ship has already sailed for the US trying to sanction and prevent this advancement in China. So I actually think the US tech AI dominance is wrestling by the graveyard as it relates to world domination. I think we can have localized domination, but China in the same way can do the same thing. They can actually turn this entire thing around post DeepSeek, where they proved they've got what it takes to compete aggressively. I think they can turn it around and say, hey, China, we're a big country. We're not going to buy any more chips from the US. And that market share will start to dwindle. It's a very important piece of NVIDIA's growth story. So I really, really think on the opposite side of this, where the risk is not being quantified by this, I'm sorry, but it is very, very entrenched, which makes it strong, but it's also hubris, where China has great advantage to take over the market share that right now US and European semi and AI ecosystem providers have been selling into. It'll hurt. So I definitely think that's a risk. But having said that, we're not there quite yet. So it's something that I don't want to take it for granted that it doesn't exist, and I definitely don't want to take for granted that Trump's going to be able to influence what he wants in the behavior through these tariffs on China, which is why he's saving, quote unquote, the best for last, meaning he can bully everybody else, but he cannot bully China. Put some a little bit on that.
In the meantime, he says, oh, yeah, well, go ahead. NVIDIA, you can sell chips to China. So I don't know how he's doing on sort of locking that down. I know there's more minimized chip or whatever. And what did he get in return? A few rare earths. But look,
he said that for Ukraine, too. The whole deal is on rare earths. The whole thing is there's an agenda that's not really believable. But
yeah, what happened there? Exactly. So I don't know if it was that equitable, but I think this is going to be a world where the arms race just kind of has to be run unfettered by logic in a way, because it's us versus them. And China doesn't care. They don't have the same kinds of human rights kind of guardrails and things like that, as we know. And so it's going to be, well, we better just push it. And whatever it takes, we're going to have to compete with them. So that makes it very interesting. That's why the semiconductors can barely downtick. I mean, literally barely downtick. And some of the names that are very integral to that, you can see just today, a little softness in the market. And the names that I love, the Palantirs, the Snows, things like that are doing okay. There was a little bit of softness out there, but it's really been quite extraordinary. I don't know if you saw some of the stuff that Nomura put out, Samantha, but the rolling, so we'll explain this, but the 1 DTE, so the 1 day 25 delta put sale, so the 3-month rolling sharp, that has gone parabolic. It's pretty amazing.
Almost, yeah, you're still going in and out for some strange reason.
I don't know. My microphone's practically in my mouth here, but let's see. Okay. So what that basically means is selling puts has been kind of guaranteed. It's like guaranteed money. We have had such incredible strength in this market over the last 6 or 7 or 8 weeks or whatever it's been. One of the most incredible rallies with barely a downtick. We know how we've shrugged off almost everything. And so it's very unnatural. I mean, I think on the one hand, so you can see this here, you've been just selling puts and basically you've been putting money in your pocket. And so a good sharp is what, Samantha, like 2? This is 10. This is off the charts. This is like you cannot go wrong selling one-day puts. It's a lock.
Until you can't.
Yeah. And so that on the one hand, that's not natural. On the other hand, I think it does speak to, you look at vol numbers across the board, everything's just down. And so Mandy was talking about this from CVO. She's saying, listen, everything's down, down, down. If I saw the VIX down, but the move index was up, some other things are up, everything is just down. So some people might interpret that as complacency. There's complacency. It's a very, very strong rally based on all these things that we're talking about, incredible unknown productivity growth. This is sort of, as I said last week, it's a known unknown. We know it's happening, but we don't know how to quantify it. We're not going to know until we start to see it start to work its way into industries and companies. And then we can kind of go, oh, okay, well, this company seemed to get this benefit from that. Even then, that's like a lot of internal policies. How do you know that a company B is doing the same as company A? So it's just going to be a whole new world of, well, how does this really affect us? And then to your labor point earlier, well, it is going to affect labor. There's zero question of that happening. Zero. So that's going to be a problem at some point. And I've been putting, you can see that I'm pushing into some of the rate sensitive areas, even some IDU, things like that are a bit more utility, a bit more power. So you get a little bit of both. You get a little bit of exposure to AI, but you also get a little bit of exposure to rate sensitivity, even though yields are quite low, as you would expect in that area. So starting to push into some of those things. They did pull back today, of course, as they often do, because Powell is yet again not coming, the dove. Yeah, he's playing ball. He's not giving Trump what he wants.
No, he's not playing ball with Trump. And the chances of a rate cut for September just fell precipitously, which is really, it worked out really well. So I want to show something on that Microsoft chart. So just real quick on the Microsoft, for those who are into technical weeds here. So Microsoft over here, aftermarket is obviously straight up. And this is the trend line that we've been talking about and showing, which had a very large up and to the right 45-degree angle. Nothing wrong with this chart. And then 55 days, it closed a little bit below. And then it got supported the next day, gapped up. And then obviously it's well above the trend line now. But if I throw a fib level on here, which is just, notice I'm on a monthly here, this has reached kind of 545, 544 area. It overshot and it should come back in here. Would not surprise me at 551, which it just hit the highs, if this has a bunch of folks shorting here in order to capture, let's say, their bullish impulse into an earnings release. You can short the stock after hours, ensure your profits if you were bullish into this print. I would see that 545 area as an area for digestion. And if it closes inside, it can start to get more profit taking. So just an aside as it relates to Microsoft right now. But what I wanted to say on the Powell front, because he definitely made the market convulse, which is we're not going to cut. And that's perfectly fine. His days are numbered. Everyone's still expecting a very dovish Fed to come in after he is done or even before he is done. We'll see how that all works out. But this is the irony. I want to show you this. So earlier today, before the Trump announcement, I was unpacking the GDP print. Now this morning, GDP came in for Q2 at 3%. Now, if you follow Trump, Vicent, and Lutnick, and Hasnet as well, they have been repeating this mantra that we will be at 3% per annum for the next 10 years. It's how we're going to outrun our debt, this massive fiscal spending. So this morning, when you unpack it, you can see that honestly, we actually had business investment decline in Q2. The economy is really only running just above 1% if you strip out all the trade noise. So in other words, the exports was quite a big component of this. Real final sales to private domestic purchasers was only 1.2%. So this is what I was talking about with the fact that we had this data come in, which was very much focused on the goods inflation contributing to the growth. In other words, front running all these purchases before tariffs, etc. But personal consumption was only 1.4%. This is important because again, consumers make up 70% of GDP. Now, what was so funny is Powell must have had this data, because what did he say in the press conference? You could argue we are a bit looking through goods inflation, which is this fake 3% GDP print, by not raising rates. I mean, he already had it ready to go. He had it so ready to go that he was not going to be cutting. And this is what caused the odds for September September to also drop quite strongly. And like I said, lucky or good, already warned that all 5 of my indicators were pointing to weakness coming in, and we did have a nice little volatility, and I don't think it's done. I think we went from 1470. Remember my 1458? We didn't get quite that. And that was my updated VIX price target on the low side from that
From 1550. You had the
down to
1550 and
yep.
then
And then I said 1458 on June 3rd. So I kind of ratcheted. I don't think we're going to hit, I think we're going to go a little bit lower. So anyway, we hit 1470, turned, we closed about 17. I think we can follow through with that 18 print pretty soon, or at least this week. And then of course, tomorrow we've got all this gamma structure coming off for end of month. So lots of SPX gamma, and we're not yet at a flip level where it starts to get a little bit more bearish. In fact, the flip level is 62.90. And what did we close? 63.64. We're not even flip gamma flip level yet.
No, there's no flip yet. We're going to need, the Pavlovian dogs have been buying every little small dip. We'll see if we can get a little bit of follow through this time. It rarely happens. Last time I think it was about 6,200 down. I think we dropped maybe 60, 70 points and then boom, right back again on some some tariff news a couple of weeks ago. But that's the interesting thing. We're starting to get finally, after all this time, and I've been melt up, we are getting to maybe a bit more of a balanced kind of environment. So we're seeing sentiment wise, the chances in the poly market, they're saying 18% chance of recession this year. That's as low. That's almost new lows. I think it's only been slightly lower. Our vol control funds, remember how we always talk about, folks, how we talk about how these terminator funds that basically have to buy when vol is low and they sell when vol gets high. Works both ways, two-edged sword. But we see that the 3-month, as I've been mentioning, we had the 1-month buying happen, and then the 3-month, which dropped some of those ugly days in April, that dropped the technical level of volatility, that realized volatility.
I know, so, you know me. I have, as soon as you say something, I want to go find the data to show it. So I just weirdly
it's like AI. You're like AI. You're just right on it.
I'm sad to say I have never even used it yet, but that's another thing. I'm very slow to embrace change. My Bloomberg terminal in my head works just fine. Okay, so go ahead, talk to this chart.
You know what? I think I was like the last person to get an iPhone. I've decided that I'm not going to be the same thing with AI. I'm on it. I'm figuring it out. I'm doing it. I'm jumping into the pool, the AI pool. And so, yeah, we can see people have reallocated. And look at that. We're almost at 0 percentile in these vol control funds. So everyone was out. I mean, it really is a V bottom in so many ways. If you look at some of these CTA allocation funds, everybody's back in. So are we now at a point where, and I mentioned this a few weeks ago, I said, now maybe we need some reality, some actual earnings, and we got them. We got the earnings. I don't know, is it based on smoke and mirrors? Is it 3-card Monty? I think there's almost this idea that I don't know if the stock market is going to take a complete departure from reality at some point, but it could be in my true melt-up scenario. But there could almost a kind of accounting rally that happens. Almost like a mechanical rally when productivity starts to sort of seep in. It isn't necessarily that companies are doing better. It's that, well, they fired 1,000 people and they figured out how to do this more cheaply and they're cutting costs because, I mean, everywhere you look, somebody's saying, well, I just saved myself. I watched an interview the other day. This guy said, well, I saved $100,000 in legal fees by using these tools. He said $100,000 I saved on this particular process that I went through. We're going to see almost like a mechanical rally, and it's going to almost be this weird irony of the stock market doing well. And as we've been talking about, maybe Main Street and Wall Street just kind of keep going further and further apart. And I know that's cynical Hans coming out a little bit, but it may be something like that. So I think the market's kind of grappling with what does that look like? What can we expect out there? But at the very least, the market knows semiconductors, maybe it's NVIDIA, maybe it's somebody else. I mean, it's probably NVIDIA, primarily AVGO, AMD, et cetera. They are going to build all this. There's no way around it. I mean, you can tell me that valuations are too high and certainly they can reset lower, but no one can tell me that this story isn't in fairly early innings. Data centers, the equipment that's required, the companies that are going to crunch the data, it is happening.
This is your bet. But in order to believe that, I'm going to, because this is what I do, I find the argument and you have to hear it.
I don't want to hear it.
And then you can dismiss
it
at your will. Of course, we are free will and it's a two-way market. But in order to buy that argument, and I'm not talking about Google and Meta screaming higher into all-time highs because of their dominance and huge moat and safety. There's no way to explain current S&P 500 levels without using at least a peak confidence PE ratio of 22 times and applying current consensus earnings estimates or super peak PEs of 24 times. This is from DataTrek. So this is what we're talking about right here. So basically the last time the S&P traded 22 times, by by the way, was in 2021, right before a quite large 2022 pullback, 35% in NASDAQ, 65% in NVIDIA, etc. Bitcoin too was trading 16,000. So at the lows before central bank intervention came in. So you know me, I'm very focused on macro policy intervention and macro event risk. And right now, this is just a fundamental review of where we are. For you to maintain your bullish bent, you have to believe that since the last time the S&P traded 24 times earnings was at the peak of the late 1990s dot-com bubble. It's our only comparison. It really is.
It is, yeah. And I don't disagree, Samantha. That's why I said, well, I don't know. Maybe Nvidia is only worth $80 in a different kind of valuation type market. But I'm just saying the stories are so strong. And I don't know, that's not necessarily helpful, but at least in the back of my mind, I have to think, well, okay, markets are story driven much of the time, but you're right.
Portfolio managers are multiples driven. And so this is the story that they have to tell themselves. This is all data trek. They do great research. To believe the S&P has any upside from here, one must be confident that multiples can either hold super peak levels and index earnings will be at least $302 a share, or that we can see fresh highs or PE multiples 26 times and future earnings are all but assured to grow 3 to 14%. So that's kind of the money quote. The money quote is that you have to be assured to grow your market that you're very bullish about is going to go from 22 to 24 to 26.
Yeah, you can't falter.
It cannot falter. And we had the same kind of vibe at the beginning of the year when I showed this chart. Remember this in December, January? We were having these talks and I said, nobody's pricing in recession risk, which would bring down these multiples X amount. And then, of course, the market rolled over February into April. And then policy intervention came back in. And we still have policy intervention, by the way. So I have been noting some policy intervention by Bank of Japan that just came in of late. So anyway, well, that's relegated for clients. But the point is, we have some shake and bake right now because of the Powell pushback. We do have intervention and the Trump put and tons of liquidity. And folks like you are who are all bowled up because of these multiples on an AI infrastructure build out and productivity. It's somewhere in the middle. In my opinion, the truth is somewhere in the middle. We don't know yet. But yeah, long story short, we're talking macro and themes, which right now Google and Microsoft are just going haywire. And the universe of stocks that support that one theme are doing really well, but the rest is not so much. It's kind of like the top line 3% GDP growth, but in reality, personal consumption is only 1.4%. So you just got to kind of balance that with Main Street versus Wall Street, if you would, please.
I think you're right. And like I said, yesterday I started selling quite a few things. I've been hedging some things. I've been hedging out my hood, a few other things. So I am a trader. I'm a trader at heart, but I try to be a little bit more long-term oriented for some of the larger ideas, which tends to be more my style these days versus doing 200 trades every day when I was a market maker. So it's a little easier to sleep at night without that kind of action. But I mean, look, there's an interesting chart that I saw. So right here, no spillover from the meme craze this time. So here's percentage of top 100 stocks with inverted call skew. So that's basically like excitable stocks. When we see those parabolas, usually that shows up in upside call skew. Everyone's clamoring to cover short positions, maybe to get excited to play the upside. And so if you look versus back in 2021, we saw that it spilled over into kind of everywhere. So the top 100 stocks, we got up to, what is that, 30 to 35% with this inverted call skew. So exhibiting that kind of extreme behavior. And I've been showing people the ARKK versus the big cap stocks. That's kind of one of my indicators, which is just sitting on its trend line right now. It's got to kind of hold, or we may have a little sort of summer pause, which I have been telling people over the last few days, been saying maybe we get that summer pause and then we get this really kind of stupid melt up in the fall. But in the meantime, this, you could look at this and say, well, okay, this really is, to your point, man, that's been very kind of concentrated in some stupid areas and even not so, I'm not saying Microsoft's stupid, but it just went up like 70% in a straight line. So that's a gigantic company. So it's in a few little meme stocks, it's in a few bigger cap stocks, but it hasn't yet spilled into that mania that you sometimes see. And I wish this went back to the .com in those times, because I don't expect it to be too much different than 2021, because it was a mania that just seeped into literally everything.
And that's a true mania. Right now, believe it or not, it's almost a little kind of localized a little bit. I thought that was kind of interesting. But you're right. Some stocks aren't doing that great. We saw
Take a look
UPS.
at
Was it
Ford.
UPS?
Take a look at Ford after hours, dumping
Yeah.
down to, it's already pathetic, unfortunately. But the point is, it's the haves and have-nots, the
Yeah.
representation of the market in its particular stocks, as well as the whole
Yeah.
Main Street, Wall Street, and all these plans that are definitely enriching still the wealthy. It's definitely not to the benefit
Here's your
of working
United Parcel
class.
Service falling
Oh
off
my
a
God,
cliff like that.
terrible.
That can't be,
FedEx to
there.
follow. Yeah.
Yeah. And if you look at the consumer discretionary, I mean, that is nothing to write home about. So I agree. The exuberance, if we'll use Alan Greenspan's term, the irrational exuberance is localized, and I think it's kind of unstoppable. Now, in terms of the story,
Oh, this
that
is
doesn't
where
mean
I
stocks
disagree
can
with you.
stop.
This is why when I look at the consumer health degradation, when I look at margin pressure coming in, all of that is still signs of potential risk despite all the liquidity. Now we're still in a backdrop of playing liquidity is bullish until liquidity creates inflation, and then it's very bearish, but we're not there yet. So we're still in that kind of edge spot where we probably next year go into a situation where the market pulls back end of this year, they come in with QE, goose the markets even more, and that becomes very inflationary. So that's why in that post I said, don't wait to hedge for this week and into mid-August is my baseline bet. More importantly, I should say.
I agree. It's time. The time is
It's
now. The
time. But
time is,
just for reversion to the mean trade, big
exactly.
picture, all the top reasons that I keep listing for weeks and weeks and weeks and weeks and weeks are still firmly in play. And just to kind of highlight AI sentiment, number one. Number two, Trump tariffs, the taco theme is still in view in that they're not as bad as expected. They're 15% instead of 25%. Bullish flows, both discretionary and systematic flows are still bid. Discretionary flows at 51%, systematic flows at 69% respectively. There's still mechanical buyers out there. Technical levers, I've got my intermarket, which is why I have said every Wednesday, hasn't done anything wrong, hasn't done anything wrong. I still see buying. Only in the past 2 days have I seen buying underneath the surface, and literally said, short term, don't forget to hedge, because right now it looks like we're going to have some degradation. And we had with Powell, and now with Microsoft and Google, everything feels okay again. But let's see what happens on profit taking tomorrow. Credit spreads are still tight, but as yields are moving higher, that will change. Fiscal spend is still in the house, no question about it. That's like all gas, no brakes. We talked about that. Dollar de-dollarization is still a main theme. It's not going to go away, even though we've had a on cue dollar bounce off some very technical levels that were basically triggered over the weekend when US and EU announced a trade deal, not a very good one, but they did end euro dollar just. The dollar bounced, and that's all there's to say about that. So I think that was an unwind in hedges, though. I'm probably on the outside. Everyone's thinking that's bullish on the trade win. I'm saying nope, it's just mechanical unwind of hedges. But anyway, yield curve is still flat, which means yields are not getting in the way of equities. They're not rising enough to be a headwind. Corporate profits are still rising, but there is some compression. I'm following that, and Jeffrey's following the bank lending at the consumer level. And we still have stable employment. So this will be the one really big one to watch. If they want to upset Powell's whole rate cut thesis, they're going to spike somehow, I don't know how, they're going to spike jobless claims and or affect unemployment. But that would be playing with the data, and that's kind of an outlier. But that is still something to think about. Last but not least, QRA funding was announced this morning. The composition, its quarterly refunding announcement of how Treasury funds all this fiscal spending. And it was really more of a nothing burger. So, but that doesn't mean they can't change after September. After September, there might be a transition of financing with longer dated, but it's hard to do when everyone, including Trump, is pushing the agenda of short duration and the Stablecoin Act. All that crap is to fund short duration. And even Japan's talking about funding short duration. So it's become a theme. Anyway, long story short, there's still lots of reasons for the market to melt up. Right now, we have a shake and bake.
Yeah, it's a kind of, I almost see the market as a bit, AI is kind of the Hail Mary. If you look at sort of 2000, 2010s, it was cheap labor, everything cheap from China, skilled labor, low cost. The internet helped to keep inflation kind of capped a little bit. And then that sort of changed a little bit, although China is still cheaper. But some of that situation has changed. changed, and then now they compete for a lot of the resources that we want and all the stuff that we need. So it's a little bit of a different situation. Globalization was a big thing. So now that's reversing, but I think AI is kind of the Hail Mary in a way that was back then. And so if you look at Slock put out this thing, I'd love to know what you think about this, Samantha. This is his idea. I'm not saying this is a huge thing for him, but he's saying AI could solve this fiscal problem. So this is the Congressional Budget Office. This is where we're heading. And then this is how AI staves us off at the pass here and does a little bit of this, and supported by probably more investment. Kind of the funny thing is, it's almost like there's all this CapEx right now. Everyone's like, well, how can there not be inflation with all this CapEx? Yeah, but all that CapEx is going directly into a system that is meant to create efficiencies and productivity gains that is going to crush inflation at some point. So it is creating a lot of spend. How much that's going into the economy, but it's going to literally make the machine that causes inflation to down over time, and I think rates to come down as well. I think they get crushed at some point. So it's kind of a weird thing. Sure, it could be inflationary in the near term. Tariffs haven't really done too much so far, but it's quite literally going into something that is literally designed to bring efficiencies and inflation down, in my view, over time.
I think it's more inflation helps really inflate the debt away, which is why this is not deflationary, honestly, in my view. But we have talked about this in write-ups before, where the dollar actually devalued. Debasement is another word, but de-dollarization is a trend. But devaluation of the dollar is going to be much, much, much more helpful as it relates to balancing the twin deficits, right, of trade and fiscal. AI is part of it, but I don't think it's the reason for the season. It's inflating the debt away. That's the reason for the season. And unfortunately, it's very, very, very bad for the middle class. Full stop. So inflation is a regressive tax. The tariffs are a regressive tax. The policies that have been passed by Congress are regressive taxes. Full stop. It is not good for the masses. It is good for wealth holders. And you're not going to change my mind on that. So anyway, but the other thing that was asked up here before I go too far on the PE thing, you just said, yes, PE ratio, it's high, but both Meta, Microsoft, Google cleared earnings growth targets of 14%. Yes, they did. And they better have, because if they did, you couldn't justify these high valuations. Your point, what do you think about risks related to pocket rescission? Clear that last sentence up for me. I didn't get that part. And have Doge layoffs hit the data yet? I don't know. They weren't as impactful because so much of it was turned around or undone through court action, what have you. Unfortunately, Doge was really, really expected to help restructure fiscal, and it would have been very, very bullish for bonds. But unfortunately, Musk was shown the door and a lot of the programs were overturned. And so therefore, we don't have the efficiencies, or cost cutting, waste, abuse, all that kind of stuff. And the layoffs, it did hit the private sector hard, but then they showed in the most recent employment data how they've hired a whole bunch back. So it really, I haven't seen it anyway. BLS is government controlled, and they haven't changed for years in this kind of 222,000 jobless claims. Severance, has it worn off? Will it start to hit the tape? I don't know. I have not seen any signs of it yet. But when it does start, it typically feeds on higher. So we'll see if we get anything going. But so far, they have not shown up.
Again, in terms of flows that are starting to get a little bit tired, the flows are starting to get a little bit tired. You can see that levered AUM. Where are these levered products positioned in? Well, they're basically positioned in tech and semiconductors and AI type stuff. So animal spirits are back. We're basically new all-time highs in terms of AUM after April's dip here. And what these do is they are also another form of what we were talking about earlier, which is mechanical buying, emotionless buying. These things have to rebalance at the end of the day. And if it's down, they rebalance by selling. But so far, it's just been up basic, and they keep rebalancing to the upside. They have to keep adding the underlying. That's how the swap product works. In order for it to give you that performance the next day, they have to actually own more of this thing to give you 2 times or 3 times the performance. So there's all these sort of things happening under the hood that keep kind of pushing things around a little bit. Lately, though, it's been just pushing up as people get in. So it's been a lot of mechanical flows, I think, since really about 5,500, 5,550. And I kind of have a feeling it's sort of run its course a little bit at this point, and maybe we do get a month and a half, certainly into seasonal.
Let me show you the 2 seasonal charts that I posted for clients. Okay, so RenMac line is expected returns over the next 3 months. From a pure seasonal perspective, we're in the weakest 3-month stretch for stocks starting this week. This is also corroborated by Jeff from Almanac's Trader. And the third is Ned Davis, who has put out, I think last last week, July 26th. No, okay, not too long ago. Anyway, history doesn't repeat, but it does rhyme. Despite the volatility, we have a typical post-election year trend. The trend peaks in early August, which means we're not even there yet. Early August. It's not even August yet. And the year-end rally is weaker than normal. So again, will this follow this fractal? But the point is, we've got a bunch of sentiment expectation that VIX bases in July. We've shown that chart repeatedly. It is the low typically for the year. And then we've got seasonally weak indicators, whether it's statistic comparisons in the past or it's Farmer's Almanac. I love that. Stock Traders
It can
Almanac.
be shocking.
I said Farmer's Almanac.
Almanac. Did those things ever work? Did people really
Oh my God,
believe
yes.
in that stuff?
Statistics actually, like I'm not into it, but you know me, I use a massive amount of data. And so I scan and synthesize, for example, that May 12th birthday rally. I wrote about that before the May 12th birthday rally, and we had a gap up and we haven't come back down since. There's something about seasonality and the behavior of particular dates and presidential cycles that are repeating. So yes, I don't follow it like closely, but I definitely scan people who are into it and don't have a bias of just all bullish, because there are some people that just always say hold for 10 years and just don't bother. And trying to time anything, but
That's true.
Yeah. So that's
Well, I mean, look, some people, if that was your view over the last 150 years, you would have had a few 10, 20-year periods where you maybe weren't that happy. But generally, I think over time, stocks do go up. Now, they are not cheap. So we are betting that there is a sea change in terms of it. And I think it has the makings of a sea change. I think this is the printing press. I literally think it is. It's not the internet. It's actually the printing press. So I think there's this possibility, but not all good. I think mostly good came of the printing press. This is going to be very destructive in some ways. So I think we have to be very aware of that. In terms of hedging, someone's asking, how far out are you hedging? Well, the nice thing is, and it can be like flipping a switch, when you get that July to August, everyone kind of goes, well, what the heck just happened here? We just had 2 months of you can't lose, and we just showed you the sharp. I mean, it's literally been no lose selling puts in this market. It's been a guaranteed trade. And so you have to just be aware. I often tell traders, listen, once you start to see things turn the other way, don't start betting against that. Don't figure the market's wrong. Once it starts giving you evidence that things have turned the other way, just be careful, especially going into that August, September period. You may be bullish on AI as I am, but there may be some softness coming, especially after this very, very incredible run. So I have been hedging. I'm probably going to keep doing that in a number of areas, but I'm looking at some option pricing right now in the SPY, very, very low, 30 days quite low. So the options have been silly low. And that's what I mentioned it. I think last week I said, listen, there comes a point where the VIX doesn't really want to drop anymore, even though what we call realized volatility, which is just, okay, how much have we been moving, which is we know has been very little. At some point, it starts to has this big gaping space between it, because realized almost goes to nothing. And you're like, wow, the market may never move again. And the VIX just kind of goes, well, I don't believe that because I've been around for a long time. So you get this really big gap, which is technically what we call volatility risk premium. That is like, boy, if the insurance is priced at 1,500 and risk is at 500, well, you should do that all day long. Well, that's what I teach in one of my courses. I say, listen, no, that's where you have to be careful. When that gap gets too big, that is a sign that things are maybe too quiet, too complacent, too whatever, because markets aren't meant to just literally go up every day. So we are at that point where I think you have to entertain the possibility that we could have a 200-300 point pullback. Having said that, I would be watching for that to stabilize into the end of the year and play further melt up. So somebody asked, well, what would you be looking at for protection? Well, when it gets kind of cheap, I think that's kind of what you want. You don't want to buy protection necessarily when it's off the charts expensive. When the roof is burning, that's not the time to call your house insurance company and go, listen, can we make a deal? No, it's a little bit too late at that point. So right now you've got, if I look out 6 months, you've got SPY option pricing that's about as cheap as got a little bit cheaper maybe in January, February, but we do have a little bit of a bid in here, and I'd have to look at the skew right now, but that's where you can kind of take advantage of a little bit of duration. So there's plenty of evidence, and we've talked about it before, the CBOE product that lost, the put product that lost more money owning the market plus puts in 2022 than the actual market, okay? So buying short-term protection, anybody who knows over the last couple months knows that can be really, really dragging on your performance, and they disappear, they're gone. So don't be afraid afraid to spend a little bit more, but give yourself something that doesn't need you to be right next week. It's going to give you a little bit of, if you buy house insurance, you don't want it to expire this Friday. Then you got to start thinking about, well, what am I going to do now? I need to buy more. It's too stressful. So give yourself kind of a 6 to 8 to 10 month duration on your protection. It's cheap.
And then I want to answer the question about rescission. So now I know what you're talking about, not recession, but yes, I've written about the government shutdown risk. So I will answer your question on that after Hans is done.
So look at this. So you're looking at about, let's say this is measuring a 30 delta put on the S&P on SPY on 6-month puts. So we've come down from the April levels. Let's ignore this historical volatility. It's a little nuts. So we've come right down and we've actually pushed a little bit lower as we've moved into Samantha's 1458 or whatever it was. We kind of pushed down, 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 down. We've broken those lows from April, from this period of April, and we're back into the lows just about of that previous period. And if you recall last year, we had a skew was cheap at one point before that August sell-off, but we're back to that point where things are a little bit cheap. So this is where you can step in. And I have not been getting bearish, but I'm saying this is what you've been waiting for as a hedger, is when things get super, super cheap. So I think you can put yourself, we talked about a put spread last week. I think if you wanted full convexity, which means just like don't worry about a spread, just grab some out of the money puts. I actually had a class last week and we sort of talked about buying almost like black swan type protection, and how if you were to buy a spread, you limit your protection to the downside. So you buy a put, you sell a lower put, and you get that protection in between, less the premium you paid. What if, and we kind of played with this, we sort of said, well, what if we just bought something further out, like a 400 put or a 420 put on the SPY, and just really loaded up and bought like 4 times as many of those, because you can afford so many more. Let's say you have a risk budget of $10,000. Well, you can afford way more puts when they're further out of the money. What you do when you shock that, so anybody who's sort of using Thinkorswim or one of these decent platforms, is you can vol shock that, which means you don't just look at what your puts are going to make if the market drops 150 points. You need to bring into the picture the fact that option pricing is going to explode. What you can do in there, this is a lot longer topic than we have time for, but you can increase the volatility and say, oh, well, that's going to make me another 40% more, 30% more. And so it was a very interesting result that showed it was quite beneficial. But of course, the further out you buy those puts, the less reactive they're going to be to a smaller sell-off. So when you do that, you're kind of betting on, okay, I can handle a 7 or 8% sell-off in the market, and I'm not going to lose sleep over it, but it's the 15, 20% end of the world that I want to protect against. In the meantime, you have to accept some of it. Yeah, it's not that they won't go up. You're going to be able to monetize them a little bit. But if you want something more reactive, so I know advisors who buy 5% out of the money puts, because they know at some point you're going to sell off, they're going to make a little money, and they can call their client up and go, hey, look, I made you some money on a few puts and they look amazing. So you can play that game as well. They're just more expensive. So I kind of like going 6 to 12 months and somewhere between those realities. So not 5% out, but I like to position around 13, 14% out minimum in terms of how far out of the money my puts are. And that's a nice place where you get that Vega exposure, which is going to give you a nice punch if the VIX goes up, which, by the way, Samantha, last point I'll make here is there was something from Nomura. Remember last year how we were talking about VIX all the time and how reactive it was to the sell-off? It was extremely reactive. We had all-time, like not all-time high beta of the VIX to the SPY, but we're super, super low again. The VIX does not care. Maybe that's another sign that we can add to our book of, wow, things are almost too quiet. Things are complacent. The VIX just doesn't care. And the irony of that is as you move out of the money on those VIX calls, there's a lot of VIX ETN buying that has to happen. So the VIX is quiet. You get the VIX to 2022 again, and it's setting up for something potentially special that's going to maybe, I'm not saying it's going to be a massive vol squeeze, but it is starting to look a little bit like that, where there are risks to the upside from those short gamma positions that market makers have on. So it's kind of, as we talk about sometimes, it's quiet until it's not quiet and it gets crazy.
All right. So this is a good segue for this question, which I thought was a spelling, but it's absolutely spot on, which is, and I wrote about this. It's funny. July 10th, I did a client post, and it was really literally all gas, no brakes meets all cuts, no inflation meets all buyers, no sellers. And the very first line is, as I was saying, the bullish flows continue. But because it's my way, I always buffer with saying, here's the upcoming potential macro event risk. And the key focus of this was shutdown risk at the end of September. We don't worry about it now. Make hay while the sun shines. I literally wrote that. But It had to do with this rescission. So I have a question. If they use an executive order to claw back government spending in last 45 days with the need for Congress to approve it, it's not a complete sentence, but the idea is the same, which I talked about early July, which is, and why Hans is like, but we still have to hedge. Not just this disturbance that I see for the next 2 weeks, at least it looks like underneath the surface that came in Monday, Tuesday, and why I wrote that. Don't wait to hedge. But this was the other reason is Vegas odds of a government shutdown. It was basically focused on this rescission rage, which is Senate Minority Leader Chuck Schumer and other top Democrats have repeatedly warned that the outlook for this year's spending process hinges on whether Republicans pass Trump's $9.4 billion rescissions package. It hasn't gone through. Long story short, now they're on recess, lots of games being played. And then I said, but make sure to track this as we get closer. But because Trump can freeze the funds, this is Alex, by the way, all of us work on the same kind of trading desk, and he likes to know how the sausage is made in DC. I do not. So he basically posted, because Trump can freeze the funds and Congress has 45 days to vote them back, which is what I think you're referring to. Normally, if they don't act, the funds must be sent. But if he enacts it close to the end of the fiscal year, September 30th, which is why you're talking about maybe the 15th, and Congress does not act, the unspent funds disappear forever. So there goes the all gas part. It becomes all brakes. Okay, so would that happen? Probably not. Trump's going to come in and want power over the purse. You know darn well this is a king type of domain where he wants control over Treasury, he's got it. He wants control over the Fed, he will get it. And right now, control over Congress as it relates to this power over the purse is a threat that the market is absolutely not pricing in, because it's just la land with valuations and AI. So go enjoy your melt up in Microsoft and Meta tonight, because it may not last. So in the meantime, we'll go back to the knitting of looking underneath to see what's going on with FX currency, rate volatility. Don't count that out either. Yen intervention. By the way, I've started to see some, and I've written about that just yesterday for clients. We also have, of course, still jam-packed earnings and non-farm payrolls and summer breezy gappy type of trading, which means we usually don't go very far very fast. If we soften in top line in the markets, we still have all of this mechanical flow underneath that still comes in and supports the market, and will until we have a macro event risk that interrupts the bullish flows. So that's still my baseline bet right now. Enjoy the softness, because your melt up and my melt up thesis of running very, very hot is still very high potential, but I don't think this week or until mid-August. I think we're going to be soft.
I'm on board with that. Yeah, I think it's had enough a little bit. I know we just had a slightly weak. It's easier to say on a weekday. You're like, oh yeah, we're finally getting some weakness, but it does feel a little bit tired. But look, Nvidia's hitting new highs. I mean, it's not like anything. You'd almost be more bearish if you saw things pull back 5%. We still are pushing to new highs in some of those areas. So it's really hard to say. But overall, the market does feel a little exhausted.
Little pause, it refreshes. Anyway, Thank you so much for asking your questions. And that is definitely rescission related to shutdown is more of a September alert. But for right now, we still have to get through this earnings week and non-farm payrolls. We will not have Powell speaking until Jackson Hole, and then the September rate cuts, depending on whether or not he gets beaten up some more on the economic front. But right now, the data has been supportive of maintaining. There has not been a need to cut.
He was so nice today, Samantha. He said, oh, we had a wonderful visit. You know, president doesn't usually visit the Fed. He's so gracious, even though he gets treated like that. It's just amazing. He's a class act.
Yeah, he's got to take the high road. That's because he's not leaving this road until his term is up in May. He said in a coffin. No, he said in a box. He said in a box. Everyone have a great rest of your trading week, and we'll be back next Wednesday for Macro to Micro Options Power Hour. Cheers.
See you, folks.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.